One of the things that I would like to ask you to do before we dive into this is to think about where you're coming from and who your audience is. It's very important to reset your perspective of your audience. Sometimes the people you're going to be communicating with are elsewhere in Minnesota. Many times they're not from Minnesota. They might be in Chicago. They might be in New York. They might be in San Francisco. Folks who are not from here, not living here, don't know all the things you know. So we need to figure out how to package projects in ways that people who are not just like you from these places can understand why they're compelling opportunities. So I'm going to walk through a narrative example of a request for financing. Then we're going to walk through a spreadsheet of how to present financial information so that investors can understand why there's a compelling investment opportunity. And then I'm going to turn it over to Lauren, who's going to go through a template of the kinds of questions that are appropriate to ask about projects to make sure when you're taking the projects that you were all thinking about, these are kind of the questions that are useful to make sure your presentation answers. I would really encourage, as you're getting to your projects and you're thinking about how to package the projects, to recognize that you need a team. It's really, really difficult for one person to understand all of the attributes, the qualitative attributes, the locational attributes, the financial attributes of a project, and to be able to coherently depict that in a piece of paper. So I would encourage you to get a team. The best teams which exist within private equity firms, REITs, et cetera, tend to have a diversity of voices. They tend to have a diversity of ages. And usually the younger folks get stuck running the numbers. So if you're not completely comfortable with the numbers, once we get to the numbers, find a really sharp young person who's good at spreadsheets. The request for financing package is going to somebody called the banker and somebody called the Opportunity Zone Opportunity Fund Acquisition or Development Officer. And the bankers look at things, what could go wrong? And they want to see a story that makes it sound like this is an absolutely sure thing and there's no risk. The equity side typically wants to understand what's the upside here. Have you underwritten reasonably or reasonably conservative so I might actually get that return or better? So they're very, very different mindsets. Sometimes people put together two different packages, one from the bank, one for equity. That's a lot of work. It basically doubles the work. So what we've tried to do here is depict everything as though a single package of information is going to both players. Your audience sees these a lot. The folks who are on the so-called front line of looking at deals would see 10 to 50 of these a week. And so they stack up, and you want to get through them really quickly. So it's really important that your first page and your second page get to the point. This is usually a 30-something to 40-something-year-old stressed out person who's come to work and has to get through a bunch of stuff really quickly. They don't want to have to do any math. They don't want to have to look up anything. They need to be able to look at 2 pages and understand, is this a potential fit? Then they typically take it from the big inbound stack to the I need to do more stack. So think about it that way. You're screening. You have to get past the maybe into the yes, we need to think about it further. A picture. A picture says 1,000 words. Ideally, put a map in. Put your name on the front of the book. This is amazing. I go through books and I have a question and I can't find how to get a hold of the person to ask them a question. There's not the phone number. Put your name, put your phone number. Really, really basic stuff. On the executive summary, if you can get it to 1 page, that's great. If it goes to 2, that's okay, but it has to be really, really clear and legible. It's really important that you be very specific about what you're asking for. Don't tell them the history of this particular intersection for 4 pages. Tell them you need $12.7 million. And how much of it you think is going to be provided by the lender and how much you're looking for the equity investor. Like, boom, right up front. Because the person who's seeing it may only have $3 million. And if they look at it and you're asking for half of $12 million, they're going to say, oh, this doesn't work. Next, next, next. You got to get through really, really quickly. So this is the kind of information. Bullets work well. This probably has a little bit too many words. Bold, a lot of times people like this whole approach where there's headlines, so they use the red pen and they scribble on the side with their questions or asterisk, yes or no. They've got to get through this pretty quickly. Once you've got the executive summary, typically these books go into more details on each of the sections. I think location is a good way to start. Location gives the basic facts and about something that they will end up Googling. And you should test. If you put some information in your package, test what comes up on Google. If it's not findable, figure out a different address. If it's a piece of land that you're proposing a new development, that typically is harder for people to find. So give them 2 streets, give them some other landmarks to make sure that you can zero in. Another little detail is the zip code. A lot of the bigger investors use market research data that's tied to zip code. Don't make somebody look up the zip code. If they can plug in the zip code, my old shop, everything was based on zip code. You plugged it in, you had like 12 pages of market data. Give them the zip code. Then we get to market. Market's kind of a tricky thing. There's a bit of storytelling in the market section, and many of the markets where these opportunity zones exist don't have a lot of data. These are often going to be in locations that straddle traditional geographies. These are locations that don't have a lot of data. These are locations that are sort of by definition distressed, and you're wanting to convince somebody that this is a location that they ought to consider. It's a little bit of an art form. Wherever you can bring data that's helpful to your story, bring data, but also try to set a little bit of context here. Why is the area important? Who lives here? What exists as well as what doesn't exist? Sometimes if you lay out, oh my goodness, there's all these things here, they wonder, well, why do we need this other thing? So maybe it's sort of a balance. There's a number of conditions that will support the project. Those might be access, highways, public transportation, proximity to parks, proximity to stabilizing institutions. And then you can talk about how this particular location will benefit from all those existing assets, all those existing investments. And there's an opportunity in this location because of its proximity to the new light rail, because of its proximity to some long-standing stabilizing cultural institution, for this to succeed. Put yourself in their shoes. They don't know the area. They don't know why. They don't know the history. They're not attached to it like you are. You have to figure out a way to communicate that story. Here's the next section. I'm probably going to get skewered, but I would argue that it's worth having a section on community impact. I would argue that if you really are embedded in a community, if you understand a community, you should be able to tell at least part of the story. What is it that the community needs and wants? How do you articulate that that's a genuine story? Who have you talked to? Is there support by the local politicians? Is there support by important nonprofit institutions that have been working in this community for years? Put the names down. If there are people who are really excited and want to help you, put their phone numbers down. Put their web addresses down. If they have great information that describes the community, why is this worth focusing on? Then we get into the property and the business plan. Now remember, there are 2 kinds of projects that are eligible: ground-up developments and substantial redevelopments. It would be very helpful if at the very beginning in the executive summary they understand what kind of project this is. Don't expect them to figure it out. Tell them this would qualify under the new development of opportunities, the Invest in Opportunities Act. Or show them some figures to demonstrate that the math works under the substantial rehab. If there's some risk that it may not quite comply with the substantial rehab, is there a downside? Is there some incremental investment that can be made that should get us over the top? There are a couple sort of numbers that are helpful here. I'm just going to walk through space measures. There are gross square feet in a building, and then there are net square feet that people lease. And typically when you're describing building a building or rehabbing a building and what it costs, you're going to be articulating those in gross square feet. So that's the outside perimeter of a building. You're building the entirety of the building. Then you get on the inside of the building, and there are corridors, there are restrooms, there are elevator shafts, there are all kinds of other things. And then there's less space that's actually available on the inside to lease to somebody. In apartments, the amount of square footage that's depicted for lease is typically the amount that you can put a carpet on. That's sort of a residential metric. In commercial space, it's either office metrics, which is a BOMA standard, which is a highly technical kind of space measurement mechanism, or it's retail, which is kind of like the middle of a line if there are two retailers next to each other. Super, super technical. If you're getting into this level, you might want to have an office broker or a retail broker as part of the team to help navigate this. One of the typical mistakes is you assume that everything is the same square footage. You're going to build 10,000 square feet, you're going to lease 10,000 square feet, you're going to maintain 10,000 square feet, and you probably goofed on a couple things. So you tend to build a lot more and you lease less. So this is a significant measure as you get into it. It's really important to go into that detail. Charts really work well, especially if you've got an existing building and then you're going to do some additional building. Lay it out as simply as possible. Show it to somebody who's never been to the property. Does this make sense? Have we articulated this in a clear way? Then you have to articulate what the business plan is. We're buying this building for $200,000 and it's empty, and we're going to add some improvements. We're going to build next to it, and the resulting building is going to be X square feet. There's a ton of granularity when you get into the building and the business plan. I find it's helpful to provide sort of the key facts in the body and then put a lot of the rest in an appendix. If you're working with a contractor and the contractor has provided a very detailed budget, maybe that goes in the appendix, because that's like too much detail for most kind of first screen bankers and acquisition people. Another thing in this section at the very bottom, but probably should have been highlighted more, is something called zoning and entitlements. If you are changing from a piece of land to a building, the logical question is, can you do that? So this is where maybe somebody in your team either comes from the city, comes from planning, is a land use attorney, and you can say, well, what is the zoning? What's permitted? What's the process to get from here to pulling a building permit to build this building? If it's going to take 7 years, we just learned about the timing, that's probably not a good fit. So you want to be able to depict something that's got a very defined timeline to get from what it is now to the ability to pull a permit. Some people use timelines, and they show, in colors, the different phases. That's super helpful. And unfortunately, because of the two different categories of eligible projects, at least half of them, which are ground development, get into like PhD level stuff. This is really, really hard stuff. Most people don't know how to take a piece of land and build a building. So don't think that everybody around here can do it. You need a team, and you need to sort of come together in a very collaborative way. Sponsor and partner. Most of the capital providers for Opportunity Zone, Opportunity Funds are just going to be money people. They're not going to bring the expertise to do all the work. So they will tend to prioritize projects where somebody else can do all the work and can demonstrate that they've done it before. Sometimes it's not completely clear how you get it done. Those projects are going to get put in the D list because they're not actionable. So it's really important to find a way with the team that's putting together the story, as well as the team that wants to get this done, that you have an idea how it's going to get done. Now that can rely upon the public or the private sector. You can say, we're going to do an RFP and we're going to get several developers to come in, or we're going to be doing the leasing and the programming, and we need somebody to be a construction manager to build the building. But it's really important to get to that level of specifics. How is the project going to get done? You don't need to tell the life story of every partner, but sort of articulate the key players and what their roles are, and then give them links to websites. So they can go on somebody's website, they can see, aha, this community development corporation has actually built 4 other workforce housing projects in the past 10 years. Huh. Or this community organization actually has 3 people who came directly from the biggest contracting firm in Duluth, and they now happen to be working as volunteers or on the board of this kind of organization. Huh, well, that's kind of helpful. Maybe they could get this one done. So get into those kind of practical issues. And then I put the appendix. So, financials. Almost all the firms are going to be really proud and have their own spreadsheets. There's no right or wrong spreadsheet. Almost everybody in this industry uses Microsoft Excel. So as you're putting your team together, try to find somebody who knows Excel. Some of these Excel spreadsheets have multiple tabs, and they're very, very confusing. For the purpose of this, and in my class, I try to keep it really simple. Keep it to a few pages, but if need be, put a little bit more emphasis on the headings, the notes, so people can understand what you're doing. So what we have here is we've got some summary information. Remember, we're focusing on square feet. It's really important that your financial sheet match the narrative that they just read. So if you talked about a 4,000 square foot building in the narrative, and then you get a spreadsheet talking about a 3,200 square foot building, they're going to wonder, do these people know what they're talking about? Do I really want to do business with these people? Maybe not. The next section is called the rent roll. Virtually every project is going to have a rent roll. A rent roll describes the leases in terms of their financial characteristics. This is a very simple project, 1 floor that's retail and 1 floor that's apartments. So we've depicted retail, unit A has a certain square footage. Apartments, there are 4 apartments above. They have a certain square footage. And here's what the rents are. And we're getting to total rents, and we're trying to distinguish between the existing apartments and the new apartments. You can depict it any number of ways, but at the end of the day, it's really important to depict square footage, lease start, lease end, rent. Once you have your basic information and your financial information, you're going to have to do a cash flow forecast. These investments are being made by people who want to get a return over a long period of time. It's not sufficient to just tell them it's going to cost $100 and you're going to get $10 back the first year. You need to be able to depict this over time. Because these projects are going to take a while to get completed, you're going to have typically a so-called ramp up where the project might actually lose money the first year, then it might hit break even, and then as it leases up, that's when you might make money. So your financial projections need to kind of show that whole history of where it starts today to when it's so-called stabilized. This is when most of the tenants are in and paying rent. And then you go from stabilized through the long-term projection. It's customary to depict 10 years. And that actually matches the desired holding period for most of these investors because they want to get the full tax benefits. So it's beneficial to show 10 years. When you do annual data, you need to figure out what your growth factor is. This is a very simplified example where everything is assumed to grow at the same rate. But typically, the leases specify how the rent changes over time, and it might be 3 years or 5 years or 7 years or even 10 years, and it specifies the whole rental stream. If you have a building with a lease that has that kind of duration, put in the actual rent over those relevant years. If you have apartments, which are typically leased for a year, and then they're assumed to go to some other level, if you're caring about the community and providing attainable rents, don't have it go up 12% a year. Figure out something that's a bit more normative and managing expectations to a level that you think the folks who you want to rent to can afford. Then you got all your expenses, because you've got your total rents, then you have to subtract your expenses, and you get to this figure, which is called NOI, net operating income. After net operating income, most projects are going to have a loan, and the loan payment is called debt service. Debt service is a combination of the interest rate you pay plus the amortization to pay down the loan. So you put in the debt service, and so net operating income minus debt service, let's skip some of the other details, gets you net cash flow. This is the amount of money that's available to distribute to the investors of the building. Now, under this is a bunch of gobbledygook that you can look at your leisure, or if you're already a developer or banker or something, you'll know what all this is. But what we're trying to do is depict over the long-term holding period what the money in is, what the money out is, therefore what the overall cash flow is from this investment. This is probably going to take a fair amount of time coming up with this cash flow. Do it as a team, take your time, you use Excel, start with a template. Then you get the capital budget. This is a very, very simple one. Most of them are about twice to 4 times as long, and they have all kinds of detail. But the big picture components of your capital budget are what you're paying for the building or the land, the hard costs. This is the kind of costs that go through the contractor for fixing up the windows, the roof, building more structure, all that kind of stuff. And then you have the so-called soft costs. These are all sort of the professionals that are doing work to help. And it could be a brokerage fee. It could be lawyers. It could be the market study. Because I did this, and I've got a few gray hairs, I just did a so-called simplifying assumption. So the simplifying assumption is that almost all deals, the sum of all these numbers are between about 18% and 25%. So I just used 20%. This is a little bit of a test for you too, though. If you have a project and you're finding that your soft costs are 30% of your hard costs, you're probably not being very efficient. So are all these folks really needed? Are their fees really appropriate? Because the banker is going to have that same assessment. Gosh, this seems like it's pretty high in terms of soft costs. Financing costs, remember this project started off vacant, didn't have any income, and eventually is going to lease up. There's a bunch of very, very detailed calculations that you can do to come up with your carry, but a really, really simple one is take the purchase price times 10% and just assume it's going to take a year. So this, again, is a very, very simplifying assumption. So then you get to your total project costs. Back to these different components. So the first thing, the rent roll and the long-term cash flow, brokers, leasing brokers, that kind of expertise would be super helpful. When you get to this capital budget, contractors, super helpful. Ask a contractor to help. Then you're going to get to how are you going to finance it. If the project has $2.5 and change million, are you really going to try to make it all happen with debt? No. Are you going to probably do it with all equity? Probably not. Most Opportunity Zone opportunity funds are going to assume that the debt is anywhere between 40% and 60%. Most bankers, when you get them on the phone the first time, will say, well, you know, we typically finance 50 to 65%. It really depends on the project. And then you say, well, this project's vacant. Well, I'm going to be a little bit more careful. So maybe it's 50 to 58%. And you say, well, the building's kind of in a mess. It doesn't meet code. And then they're going to get more conservative. And then you say, oh, and by the way, I'm not going to guarantee the loan because I don't have $1.5 million. Oh, we're going to get really conservative. So your loan is going to go down, 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 down. So I think it's reasonable to assume a 50% loan for underwriting purposes. And if you can bring 50% equity, you probably could get even a reasonably conservative lender to lend you half. So then you get to these figures of the share of costs funded by an Opportunity Zone opportunity fund. Then we get to all these calculations. One of the most important metrics is something called return on cost. So your net operating income divided by your total project costs gets you your return on cost. Many people compare projects based on their return on cost. I would argue that's probably the first calculation you should make. In sort of hoity-toity high finance, there's a relationship between the return on cost and something called the cap rate. So if properties which are completed are being sold in the marketplace, they're going to end up having a somewhat similar kind of market return. That's called the cap rate. If you're going to take the risk of building something new and leasing it up and going through all of this stuff, your return on cost should be higher than the cap rate. and it should be higher by at least 150 basis points to 200 basis points. So said differently, if your cap rate is 7, you'll want to have your return on cost around 9. So that gives you 200 basis points or 2 percentage points above your cap rate. The leasing brokers typically won't know these numbers. So you'll want to go talk to a banker or an investment sale broker. So that's the folks who will know some of these finance numbers. Or start calling around. Maybe you go online, you find out there's 2 opportunity zone funds poking around. Call them up. Hey, what kind of returns are you looking for? What about in my city? What about for this kind of project? And they'll give you ranges because they want the projects that are being submitted to them to be more actionable. So we should turn it over to Lauren. Thank you very much. So this is the dirty, nitty-gritty stuff. If you have questions, feel free to reach out. Think about it as a team. It's going to take time. We probably goofed, so some of the math might be wrong, but at least it should be a start. Lauren.
I think that finding the key tenants for these developments is going to be a key. And I know in conversations I've had with nonprofits or nonprofit arts groups, you know, a lot of them, I'm from Northeast Minneapolis, and there's a lot of artists in Northeast, but a lot of them struggle with rents going up or neighborhoods getting more popular. They tend to be trailblazers and get to neighborhoods when rents are cheap and then bear the brunt of the increase in the neighborhood by having rents that escalate or double or triple. So I do think that there's a good possibility to find partnerships with nonprofits who can have maybe a more fixed rental rate over a 10-year period, or have an option to purchase a building at the end of that 10-year period. Because, you know, the part that Jamie didn't get to is like, well, what happens when you sell this building in 10 years? Like, who buys it? Where does it go? Who owns it then? How do we know that that mission continues? And so having those tenants in there that become the owners of the building and keep an ownership local and on a local level is, I think, where some of this funding gets interesting. And there is nothing in this law that says they have to sell it at the end of 10 years. That tax break can go on for 20 years. So, you know, it does get interesting, or it's something to think about. How do you attract these tenants who are going to pay the rents, and how do you make it so it's a better deal than, say, the private market, right? If I go sign with XYZ broker or landlord, you know, how do I know that our rents are going to be stable or increase on a stable basis, or how do I get the benefits of being the pioneer and come into this area? And it kind of goes back to that, like, Wayne Gretzky quote of, you don't want to skate to where the puck is, you want to skate to where the puck is going to be, and that's where these opportunities